I was at the movie theater and got an iced tea. That thing was $6. A cup of iced tea.
This is my favorite segment of the show. We need new music just for old men screaming at prices.
I said I was watching myself a film. It was real good.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Welcome back to Skippy and Doogles Talk Investing. SkippyDoogles.com, that's where you can go for all your Skippy Doogles needs. Follow us on the platform of your choosing. And we love listener mail. There's going to be a couple pieces of listener mail we hit today. SkippyDoogles@gmail.com is where you send your thoughts, your provocations, your complaints. We love it all. Today's show, we're going to start off with a way back machine type situation, looking at Seth Klarman's Forgotten Lessons of 2008 that he put out back in late 2009. Then, as promised, listener mail. There are a couple pieces of listener mail. One is touching on affordability today and what that means, and the other is looking at working class Americans and how they're investing in the stock market right now. You look like you were about to say something.
I mean, you just can't help yourself. It's disappointing to me. You have to, every show has to be bubble is about to pop show. Let's talk about 2008. You just can't help it.
It was a random year. I can't choose random years. Fine, let's 1929. You choose a random year.
I'm just here to give the people some like smile-based entertainment, not some doom and gloom.
Well, then you start. What's your smile-based entertainment?
I don't know, but great. Let's talk lessons of 2008.
See, exactly.
So excited about it.
Okay, Seth Klarman, Baupost Group, one of the most successful investors of our generation, value investor. So congratulations to you there, Skippy. In late 2009, he started to see many of the same mistakes repeating themselves that he just witnessed back in 2008. And he's like, what's going on up in here? Like, why can't people remember yesterday? So he put out 20 investment lessons of 2008. I'm going to go through all 20, but I'm going to hit on them like rapid fire. Won't even finish full sentences in some cases. I'm just going to say enough to get the lesson. Number one, things that have never happened before are bound to occur. Number two, when excesses such as lax lending standards become widespread and persist for some time, people are lulled into false sense of security. Number three, nowhere does it say that investors should strive to make every last dollar of potential profit. Number four, risk is not inherent in an investment. Number five, do not trust financial market risk models. Number six, do not accept principal risk while investing short-term cash. Number seven, the latest trade of a security creates a dangerous illusion that its market price approximates its true value. Number eight, a broad and flexible investment approach is essential during a crisis. Number nine, you must buy on the way down. Number 10, financial innovation can be highly dangerous. Number 11, ratings agencies are highly conflicted. Number 12, be sure that you are well compensated for illiquidity. Number 13, at equal returns, public investments are generally superior to private investments. Number 14, beware leverage in all its forms. Number 15, many LBOs are man-made disasters. Number 16, financial stocks are particularly risky. Number 17, having clients with a long-term orientation is crucial. Number 18, when a government official says a problem has been quote-unquote contained, pay no attention. Number 19,
that's the best one.
The government, the ultimate short-term oriented player, cannot withstand much pain in the economy or the financial markets. And number 20, almost no one will accept responsibility for his or her role in precipitating a crisis.
Whew. He goes on to say, not the leveraged spectators, not the willfully blind leaders of financial institutions, and certainly not the regulators, government officials, rating agencies, or politicians. You're on your own out there, right?
No one.
My two favorite back-to-back were financial innovation can be highly dangerous and rating agencies are highly conflicted. Like, It is good to go in the Wayback Machine and just kind of take a reset of all these. What was it last week? We were exchanging texts, and it was the OpenAI CFO had a write up clarifying some things. She talked about financial innovations, and I was like, Doogles, this is it. This is where we are now. Whenever people start talking about financial innovations, better watch out because we're in trouble.
Mm-hmm. It happens in my house too. When I go to my wife and I'm like, I got an innovation to show you, she knows there's some janky piece of crap that I have tried to configure instead of doing something properly. Like that is the only outcome after I say that. Which other of these do you think are either pique your interest, we should talk through further? Because again, in some cases, I didn't even finish the sentence. Like you finished my last one at number 20 there.
The leverage piece is huge, especially if the market is really expensive. The call-outs of you have to get compensated for illiquidity. Hopefully, I don't think a ton of our investors are in a bunch of illiquid private credit or venture investing. But if you are and the market has a tough time, you better be handsomely rewarded for that. Yeah. Because the ability to be liquid in a time of crisis is such an incredible privilege. So that ties into point number 13, which is public investments are generally superior to private investments. Wholeheartedly endorse.
Yep.
Completely there.
I like number 3. Nowhere does it say that investors should strive to make every last dollar of potential profit. I like that one a lot. I think it comes up in a variety of factors. When it ties into the one where he talks about cash and not taking risk on short-term cash. It ties into that one. And the way that if in case it's not obvious for some folks, the way that plays out is if someone's like, I could buy this treasury bill. Look at, I don't know, pick random company in Peru that is issuing a bond that you've never heard of but is paying 9%. It doesn't mean that that's good or bad. It's just like, are you risking principal for something short term? Risking principal long term that's investing, but short term, something. I think that one's important.
I've talked about this in my non-quantitative portfolio. I've certainly shifted to a much more conservative approach with bonds and cash and other things in a way that I don't often do historically because I feel like the market is so expensive and fragile in a way. Mm-hmm. It sucks though, right? There's plenty of equities that I feel like are a good deal that I'd like to buy. I know I'm sad. It's like pulling teeth. It's really painful, but I believe it's the right approach. And to me, that's what he's saying in number 3.
Mm-hmm. Yep. I also like you must buy on the way down. I like that one.
Let's talk about that. Why do you like that one?
So there's a part of it that has to do with investing purely, like the financial returns that can come from that. There's another part of it, to me, that's more mindset-wise. Mindset-wise, I'll start on that end. If you can't buy on the way down, psychologically, and this applies to whether you are dollar cost averaging just over your lifetime in a broad fund, or whether you are, which should be most people, that's the 99%, or if you are buying individual stocks for the long term, either one of those, if you can't buy on the way down, like if you stop your dollar cost averaging during that time, or you're like, just mentally I can't get there, then I think you should check your psychology relative to your investing philosophy. So that's like the mindset piece for me. So you could change that to say you must be able to buy. That's one. I'll pause there and then I'll go to the other one and get your reaction.
That's perfect. So if you read the rest of that thought, he says there's far more volume on the way down than on the way back up and far less competition among buyers. So one, I completely agree with the point. You really can't be an investor unless you can handle fairly frequent, like once a decade, 50% losses of your portfolio. That's just how this works.
Yep.
That's the price of admission. His clarification about saying how there's much less competition means much lower prices, which means you set yourself up for the next decade of outperformance.
Yep.
Completely get it.
And we're going to touch on that once a decade point when we get to part of the listener mail, because people are understandably interpreting 2020 and the March, April 20 decline and 2022 as proof that they can withstand downturns. and actually bringing in April of this year, Liberation Day.
Yeah.
Those are not what we're talking about like in 2008. Like those are very different than 2008.
No,
it's training.
downturn.
They're like training wheels.
It's not even that. It's like I don't know, doing a VR video game of whitewater rafting and then actually going out and do whitewater rafting and having your boat get flipped over and not knowing how to swim. I mean, it's so drastically different. Withstanding I don't remember the exact downturns there, but withstanding a 20 to 30% downturn that very quickly reverts and the stock market goes to all-time highs within like 6 to 7 month period is nothing. We're talking about 40, 50, 60% downturn over multiple years where every day you wake up and read the Wall Street Journal and there's nothing but negative news. Yeah. The psyche is completely different. We're talking about a downturn where maybe the NASDAQ goes down 80 or 90% and it takes you 13 years to recover to the previous highs.
Yep.
Maybe 20 years. Maybe it's Japan. Maybe it's 35 years. Like,
and I'm gonna take that example because it's important for folks, even if you know it. I think it's important for these kinds of things to be repeated so the facts stick in your head. But to take what you said, if you look at the year 2000, I mean, we're going to do the S&P 500 and NASDAQ. S&P 500 from 2000 over the next decade produced no returns, meaning like there were some ups, there were some downs, but if you just take the full decade, you had a 0% return. It did not get back to where it was in 2000, I think, until like 2012. It was like something like that. 2011, 2012.
Yeah. One quick interruption. Shout out to Klarman, because that's for the person that bought at the peak and then got scared, right? The person that bought all the way down, then had pretty awesome.
That's right.
In some cases, depending on how much money you applied at the trough versus the peak, you had some pretty awesome returns during that period. That's why it's so important to keep investing.
Yes, that's exactly why it's important. And the reason I brought it up in relation to what you were saying was because when you have the quick turnaround, like let's call it within a year, you're back to all-time highs, and then it proceeds from there. We're talking about a decade later, you were not back at all-time highs. The NASDAQ from 2000 to its trough, peak to trough, went down over 80%. So I'm going to take your analogy one step further that you brought up. It's you're training whitewater rafting on a VR simulator, and then you're on a Class 5 rapid. Isn't that the highest? Isn't it Class 5? Class 5 right. Rapid in the dark. Like that is what it feels like. It's like there's not even hope. So it's just important, like, for folks to realize that. I think that these are...
Well, there is hope, though. Gosh, I sound like a professor or something. There is hope if you plan for it, right? If you have a nice cash position and have conservative investments, then you effectively have a flashlight and a life jacket. And these other, like, our analogy has gotten pretty stupid here. But there's like, don't be kamikaze in with a pair of swim trunks and no life jacket to the Class 5 rapids is all I'm trying to say.
You have a flashlight and a life jacket, but there's a seagull pecking upon your neck.
And the government is throwing a monsoon your way.
Yeah, and the government has closed the national park. All right. Anything else you want to point out from these 20?
No.
All right. Excellent. Okay. We're going to hit a couple pieces of listener mail. So hit that jingle.
They fight and fight and fight and fight and fight. Fight. The Skippy and Doogles Show.
Let's start off with this piece from John. Thank you, John. Wall Street Journal. It is titled, "More Working Class Americans Than Ever Are Investing in the Stock Market." These numbers are interesting, especially given a couple weeks ago we went through that report the Federal Reserve of Philadelphia reported around people investing. Among Americans with incomes between $30,000 and $80,000 per year, 54% now have taxable investment accounts. Half of these investors have entered the market in the last 5 years, and this is a survey from Commonwealth and the BlackRock Foundation. First of all, I'm going to say this before we even hop in. The difference between $30,000 a year and $80,000 a year is massive. You could have 100%
unless you're
of these
living in your parents' basement.
All I'm saying is when it's that broad, but given that the median income in the U.S. for households is like $58,000, something like that, You could 100% of these people could make $80,000 a year, and you can say people between $30,000 and $80,000 a year. 54%.
Come on now.
I'm just saying,
understand the point.
it's so broad. No, because $30,000 is like just it's a very different. If you told me that 54% of people that make $30,000 to $35,000 a year, that's a different stat. That's all. That's all that I'm
completely.
saying. Very different stat.
No, 30,000 is not far above the poverty line, correct?
No,
I haven't looked at those numbers
depending
recently.
on family size.
Yeah. Yep. And Douglas mentioned it, but just to be crystal clear, like we understand we're talking about two different research reports here that seem to be contradictory. 2 weeks ago, we told you 57% of Americans do not invest, and we told you why they do not invest. And now it's saying in this lower income bracket, you assume the higher income bracket is better, and it almost always is. More people investing. This says 54%. So we're well aware of the contradictory nature of these two studies. I think they both have validity. And I'm kind of delighted. I'm kind of delighted about one sentence.
Oh.
I have it here in my notes. I love this. Says, so we might talk through some of the examples. Cheesecake Factory waiter, I believe, the chef, all these people that are actually investing that detail this. There is 100% survivorship bias in the person that raises their hand and says, I'm a lower income person and I want to tell the Wall Street Journal about my investments. So that's also very clear. These people have had decent returns. That's why they raise their hand. But the sentence I loved is home ownership, one traditional method by which prior generations in America built their wealth, has moved out of reach, just as trading stocks became easier and cheaper than ever. I'm not claiming that you should not desire to build your family in a single family home if that's what you want or whatever. You get to have whatever American dream you want. I think home ownership can be great for the large majority of people. But this is a really good point. If the average home in the place you live costs $1 million and you're in this income range, it seems out of reach. What I love about this highlight and maybe this trend, I do think when the Class 5 whitewater rapids come, there could be some shaking out here, and I hope that doesn't happen, but that's just how it works. But I love the trend of saying the traditional way that my parents built wealth maybe isn't available to me, but there's other avenues for me to do the same thing to better my prospects 30 years down the line.
I love people being involved in the stock market. Absolutely love it. What I wish, can't get everything you hope for. What I wish was if this was March 2009, which was the trough of after the great financial crisis, and this stat was true, I would be like dancing all up and dancing on the ceiling. I would be so excited.
You're in dreamland. I love your wish. But that literally cannot happen. When the stock market goes to all-time highs, that's when the participation in the stock market goes to all-time highs.
No, I know. I understand this. This is why, all else being equal, I really think this is a great thing. And I think it's generally good that people are getting involved as long as they don't get burned and don't come back later. Or don't stay in.
I guess I have your same hesitation. There's like a graph in here that shows the share of people participating effectively. And it's always like when more people buy stocks, the price of stocks is higher. Of course, that's how economics works. Like this is not any great shakes. Anytime the CAPE ratio, cyclically adjusted price to earnings ratio, is above 40, which is a historic high effectively for the U.S., it means more people are buying stocks. That's just what it means.
Yeah. And the reason why, one of the reasons, there are plenty, one of the reasons why I'm not allowed to edit a paper like the Wall Street Journal is because the article I would love to see is the vignettes they have, people being like, oh yeah, I'm a waiter at Cheesecake Factory and I put my money into a low-cost index fund and have no idea how it's going. Oh, the stock market's going well? That's what I'd love for the vignette to be. That's not what's happening here. The people that they highlight, understandably, right? I get all this. This is what you have to do. But the folks we're highlighting are, one, you mentioned survivorship bias, who's going to raise their hand. And two, this is trading that's happening here, not investing.
Oh, completely. It's Palantir, which, what did we say last week? Trading at price of sales of 90 or something. I don't know the exact number. And the guy is like, well, I've made 900%. Of course you had. This is day trading it's good for you. But you don't have to hold on to the thing forever.
Here's a quote from that guy. Yeah. It's kind of like a game. If you love a game, you're going to want to keep playing, especially if you're good at it.
The game hasn't hit class 5 rapids yet. Okay, here's the other thing that I think is really important, and people miss so. Your average investing community misses so much of this. People talk about their performance and compare it to the S&P 500, and should they ever? I understand why you do that. But you know what's better than that? Actually setting money aside for your future. So whatever the mechanism is to actually increase your savings rate, right? If the S&P 500 makes 10% and you make 7%, shucks, that's horrible. You know what that's better than? If you put $1,000 aside in that perspective life, where in another perspective life, that $1,000 disappeared, or that $10,000 or that $100,000, if you're actively saving and you can find a mechanism that does that for you, and I think the individuals detailed in this article all are doing that, and they are motivated by the fact that this is a fun game in stupid quotes, right? Like that is really good. Because even if you set $1,000 aside and you happen to lose 50% of it, you still have $500 that you probably wouldn't have had in sports gambling. It probably would have gone to zero, right? So that gets so lost in the shuffle. Like, what is your savings rate? What motivates you to put money aside to better your optionality in the future? So in that case, this is a huge win.
But if you are sports gambling, Jameis Winston's starting for the Giants this weekend, so just double down, baby. Double down. I completely agree with that. And I hope that genuinely people understand that I love folks being in this income range, being in the market. I love it. It's the mindsets that I think are really important. I'm going to read one other quote from somebody here. This is his Godfrey Jones is the person that they quote here.
My man. I like Godfrey.
I would have started a long time ago had I known it would be like this. I'm going to separate this sentence into two halves because this is I'm going to take you on my emotional roller coaster during this very short sentence. I would have started a long time ago. Yeah, Godfrey, that's my boy. I'm glad you're in the market. You're excited. You would have started a long time ago. So happy for you. Put it away. Tell your kids about it. Love it for you. Second half, had I known it would be like this. That's where the danger comes into play.
What's so bad about that?
Because you know that what he means by had I known it would be like this means had I known that you get guaranteed 20% of your returns or whatever he's like spitting out right now.
No, I disagree. Don't talk trash about my boy Godfrey over here.
I'm not talking trash about no Godfrey.
This is a better sentence. Okay. After stumbling upon an investing app that let him open an account for just a $20 initial deposit, the 45-year-old purchased fractional shares in companies like Apple and McDonald's. He loved watching the dividends grow from 5 cents to 10 cents to $100 or more. This is the hack. I understand why people talk trash about dividends. I totally understand. When you start something with $100 and then a few years later you get $100 dividend and you go, that's the entire value of my whole account. And you go, wait, and I didn't have to actually show up for my shift at McDonald's? Like someone else did that for me? It's incredibly powerful. He's like addicted to the free money that can come with wise investing, and it's great. I love every aspect of it.
Yeah, I might be taking too negative a look because I agree. There are lots of things about when Godfrey's little vignette. There are other parts I like about it. So when he says, I was surprised. My mindset was that I had to already be wealthy in order to invest. Boom, dropping knowledge. Again, tell your kids about it. Love that for you, Godfrey. My concern, though, because if you go a little bit earlier in Godfrey's story, he talks about, and hopefully this is a lesson learned because he mentioned as a lesson learned, he talks about in early COVID times how he was like, oh, and pulled a third of his money out. And he says, I think I learned from it. So what I hope, because that happens, right? When you're early in investing, these things happen. I'm not talking bad about it, so I'm not faulting him for it. I just hope my concern with that last part, had I known it would be like this, is that it's about the up and to the right nature.
No. You're like the algebra teacher that never allows a student to get a problem wrong. Like, this is part of the learning thing. There's applause.
Why are we getting problems wrong?
He's allowed. He's a unsophisticated first-time investor that goes through a worldwide pandemic and has a panic moment. Investing takes 20, 30 years, I was going to say, to master. No one ever masters investing, but like, this is a hard thing to learn, and the best way to learn is with experience. This is really good.
Okay.
Don't stop being so hard on my boy.
I even said, and I understand it. That makes sense. I said these kinds of words.
And now he's on a worldwide podcast catching
Yeah.
some shade.
No, you're right.
From
You're
you.
Right. Bring Godfrey on the show. You're right. Love everything about it.
John,
No, I
thanks
do.
for the
I do
listener
love it.
mail.
I do love it. Okay.
Yeah.
All right. Next piece, listener mail.
Yes.
This one comes from Josh. It's on a blog post. Affordability is just high nominal prices by Matthew Iglesias. There are a lot of politics in this piece. I'm not going to hit on those because I know how you feel about it. I'm not going to hit on those.
I was
What
going to
he's
say
saying.
this piece barely made it through this barely made it to the show because it's there's some political
There's
stuff
so
going on
much.
here.
But it's I think like a very good look at the differences between what data is showing and the sentiment that exists. And what Matthew does in this piece is says, if you look at those differences, how do we define affordability? And even in the title, affordability is in quotes, because this is what the whole point of his piece is saying, I'm on a search for what affordability means.
I enjoyed the piece. I'm going to let you give the background, and then I am going to surprise you with the world's best app idea to solve this issue.
Robinhood.
Or 20% of this issue. But yeah, go ahead.
Okay. So the data that he shows, data all of us has probably seen, done talked about before. He looking at real, which means adjusted for inflation. He looks at real median incomes and saying, we had all-time highs, right? All-time highs, real median income, which would mean that when you adjust for inflation, the amount of money people are making is higher than it has been before. Mm-hmm. Then he also looks at consumption because people are buying more than they have before. You're making more money. You're buying more things at a median level, which takes into account the whole situation.
Yeah, everyone is screaming that the world is too expensive and I can't afford anything.
Exactly.
That's like the real dynamic that's happening. More money than ever, more spending than ever. But my goodness, I can't afford the burger down the street.
Exactly. And I'm going to read this quote, and then because I think it's great, and then we'll go into his search for what affordability means and how he landed on that title. Quote is this: when people feel like they're living through an affordability crisis, they really do not want to see your charts and graphs.
It's brilliant.
And I think that's true. Where this involves a president, so whatever. But what he's saying is that back in the Biden era, he said basically what the Biden administration did was say, like, no, things are great. You're saying things are bad. No, but look, things are great. And like that doesn't.
No, there was many big mistakes, but one of the biggest mistakes was, well, the number says this, and the person that was at the grocery store feeling like they couldn't afford whatever for their kids said, I don't care what your stupid charts and graphs say. And rightfully
Exactly. So. He goes and says, so what is affordability? Because what we're seeing that affordability isn't is that, again, in aggregate and the median. So you have to look at this in aggregate for this piece. He says what it's not is saying that your income is higher than the costs of things have gone up. So it's like that seems like that's not what affordability is. So therefore, what is it? And the part I'd like to talk, I'm just going to skip back to the headline because I just want to get your reaction to that. Where he lands is he says, just like the headline says, it's just about nominal prices. It's about the price. When you show up to the grocery store and chicken in your head is $5 for whatever that amount of chicken is, and that chicken is $8, it's not affordable. It doesn't matter
if your salary is increased by more than that.
Exactly. Chicken should be $5. And there's another point around that he raises, where he goes, if my salary goes up, that's because of work I did. It's because of the hard work I put in. When the price goes up, what you doing to me? So like if my salary goes up and the price stays the same, that's amazing. Because I've already anchored myself to that. But if that's not the case, it's not good.
This happened to me this week. I went to buy a 12-pack of soda for my household. I don't drink soda much. And it was $11. And I purchased it and tried to jump off something. Like I thought a 12-pack of soda cost $3. Honestly, I thought a 12-pack of soda cost $3. Which I know is nonsensical because one 20-ounce soda can cost $3. I just hadn't purchased that thing in a long time. My goodness, does that seem expensive?
I was at the movie theater and got an iced tea. That thing was $6. A cup of iced tea.
This is my favorite segment of the show. We need new music just for old men screaming at prices.
I said I was watching myself a film. On that film, it was real good. Yeah, but it's real. That's the point he's saying, and he's like, and if the idea is that nominal prices have to go down in order for sentiment to change and or real affordability to change, that's hard. Like, the way to do that is hardcore recession, or
the way to do that is take interest rates to 12%,
exactly,
or 15%.
The way
That's
that
what's
is hard.
so amazing about the early Reagan years. Everyone is in equal pain together, but prices stopped. They completely couldn't go anywhere because no one had any money to spend.
Yep.
This is why I've been screaming about raising interest rates for 5 years. Anyway,
So going back to the consumption piece, when real consumption is also at all-time highs, your prices ain't going down.
no. Why would they?
You gonna answer that question?
I don't have an answer. Bear with me for a second. There's an example in this piece that I really enjoyed about a bachelorette party.
Okay, yeah.
Bachelorette party costs $800. One of the gals feels like she can't afford it, maybe, and there's some debate. Should I put it on a credit card? Should I not go? My favorite is when she says, I don't think I can afford this. Her friend says, sorry, you absolutely have to come because the other people can't afford it if the cost of the Airbnb, if you don't cover like 1/5 of the Airbnb. I love this. There's thousands of studies of people on their deathbed, and they ask what you wish you did more and what you wish. And it's always like friends and family and, more adventures, basically, more experiences, less work. That's basically how it breaks down. But this is a very real problem. Someone at 24 or 27 or 32, I don't know how old they are, early in their career. 32 is not early in your career, but the sim you're in your 20s. It can be tough to come up with $800 to go.
That's a lot of money.
Spend time with people that you truly love and hopefully are lifelong friends. The flip side of that is a bunch of people that are 60 plus, multimillionaires, sitting on more money than they could ever spend, probably sitting in their couch wishing that they had a bachelorette party to attend. Yep. There needs to be some sort of app that allows the 24-year-old in this example to go to the 70-year-old and say, I'd really like to do this. Anyone have $800 for me?
Money sharing?
It's like experience time. It's experience time travel for the people that are on the wrong side.
Hold on. Am I hearing this right? So here's the exchange. There's no interest involved.
No, it's free money.
The 70-year-old. No. Hold on.
Yeah.
The 70-year-old gives this nice young woman $800, and in exchange, she live streams the bachelor party from her GoPro, and he gets to watch.
She says, "Send me some pictures and show me like the drinks you got. Show me some dancing on the table."
Okay, all right.
It's an example, but this app, I'm telling you, would make everyone's life better. It'd make the 24-year-old in my made-up examples, it'd make their life better. It'd make the 70-year-old's life better. And $800 to the 70-year-old I'm talking about, I'm not saying it's the average 70-year-old, means literally nothing. Like literally nothing. And to the 24-year-old, it's a life-changing, memory-defining, life-changing is a little strong. It is a big part of their year, right? You forge friendships that last for the next 20 years.
You're going to drive up inflation. You're going to drive up inflation even further.
No, I'm going to make people happy. I'm going to.
No, yes, and you're going to make people happy. Both of those things can be true.
This app needs to exist. Luckily, my kids don't listen to the show because I don't want my kids to know that if at 25 they hit me up and say, like, there's some crazy surf trip in Indonesia happening and I need a few bucks, I'm probably going to write that check. They're like, you're only young once.
So, I mean, speaking of which, I'd like to go to Indonesia. Can I have that check? You don't want to see like a man in their 40s adventures in Indonesia. So I read The Art of Spending Money, which I know you read and recommended to me in your sadness after reading it. And this does remind me of one of I can't remember who it was, but there was a billionaire that he was talking about in there who got to the end of life, or maybe not like deathbed, but toward the end of life, and basically was like, I have no friends. I have nothing to do with this money that I'm now like sitting on. I can't remember if it was like his kids don't even talk to him. I don't remember what the situation was, but it was dire.
Yeah.
Like the situation was very dire. You make me think about that because that's a real situation. Also makes me think about Die with Zero, the Bill Perkins book. That's who wrote it, right? And they're all kind of telling the same-ish kind of story without your app, though. That's different because...
Do you know how many... I'm not trying to interrupt. We'll get back to art of spending money, but do you know how many people spend 40 years grinding in some job and say, I can't wait to travel when I retire, and then don't have the health to travel when they retire? I'm not claiming it's the best solution, but if you can send a few bucks to this group to go travel and have fun and kind of live through them, I don't think it's the worst solution either. I think there's something to this.
Yeah.
The app probably already exists, to be honest.
Yeah, it's called JP Morgan Chase.
Yeah, JP Morgan Chase has the here's some free money, go have a fun bachelor party fund. I just didn't know about it.
You show me the public stock that has this free money app, and I'll show you a stock to short. That is.
No, I'll build the app. I'll take a 5% commission on all money transferred.
I'd like.
There we go.
You're not. I'm making fun of this app, but there is something to what you're saying right now. There is something.
Listen, we're a worldwide podcast, so our friends in Guatemala, can you build this already and send it my way? I will get you plenty of publicity for this.
Or this individual, the 70-year-old you're talking about, could have their own collection of Airbnbs, and inside the Airbnb is just piles of money. So you show up to your Airbnb, and there's like money for you to spend on your vacation.
No, you need a story. You can't.
All right. Okay.
You need a personal connection. People do not get happiness from giving away free money to people they've never met and never heard of. There has to be a
story. Has to be a story. That's fair. You got anything else?
No, that's it. So listener mail, we at least got to a couple today. skippydoogles@gmail.com. If you want to get the show early, here, early stock research recommendations, and all sorts of other fun stuff. Yearly portfolio reviews, which are coming up.
That's right.
You can go to skippydoogles.supercast.com and support the show. We are so thankful to people that support the show. It just makes it easier to produce and put together, easier to research, a whole bunch of things.
Yeah.
We are a collection of the people that support us. That's why we do this every week. So we'd really love for you to check that out if you get a chance.
Appreciate y'all. See you next week.
Peace.